Eight, 7, 6, 5, 4, 3, 2, we are live.
Good evening, everybody. Thank you for joining us on this webinar. We will be having a realistic discussion on matters retirement. So thank you all for joining us on this webinar, where we will be having a realistic discussion on matters retirement. Reason I'm saying realistic is because we have two experienced retired persons who will be speaking this evening. My name is Hazel Kimori. I work at the Association of Kenya Insurers, and I'll be your moderator tonight. Just a brief background on the Association of Kenya Insurers. We are the umbrella body for all insurance companies in Kenya. And our key mandate includes consumer education, which is why we are here today. We're also responsible for doing a lot of market research within the insurance industry, capacity building, and lobbying on behalf of insurance companies. We are here today, as I said, on the education mandate, and we have a great panel with us tonight. We let each introduce themselves as we kick off. And remember to put in your questions in the Q&A function. So I'll start with the gentleman on my right to introduce himself.
Thank you, Hez. Good evening. My name is Dr. Edward Odundo. I'm a former Chief Executive of Retirement Benefits Authority, close to 16 years. I'm now retired, almost 8 years now. So I've been on both sides, policy issues and regulations, and now I'm on the other side of actually retiree. So the policy, I always say that not everything that I put in place works in retirement. It doesn't work. Some of them don't work. I'm also currently lecturing at the University of Nairobi, and I'm the director of business, School of Pension Retirement Studies. I sit on the Equity Group Bank and chair the Equity Life Assurance. Thank you.
Thank you, Hazel. Thank you, Edward. My name is Ayuna Thino, a retired insurance professional, having a span of about 37 years to retirement within the insurance industry. Kenya National is where I started my profession as a trainee. Then I did it at Standard Chartered Investment Services, and ICA Lion Life Company is where I retired from. Currently, I have been on retirement for this is my 4th year, and I can tell you retirement is exciting. Yes, it is exciting, but for the prepared. So thank you, and we catch up as we continue the discussions.
Thank you, Hazel, and to my fellow panelists, Dr. Edward and Ayuna. My name is Paul Rege, and I am a practitioner in the insurance space, and specifically retirement benefits arrangements. Currently, I sit here under the ambit of Association of Kenya Insurers, where my current employer, Madison Insurance, is a member. I have been in the retirement benefit space for about, I think now 16 years. And it's something I love doing. It's something I enjoy doing, and I've done it quite a bit. I've been around the insurance industry up to this point where now I'm in Madison, and I'm looking forward to the conversations that we're going to have. As I always say, every day is a learning day, and now that I have my seniors here, my regulator, former regulator, as well as a senior practitioner in the industry, I'm also here to learn, and I hope you'll be learning alongside me. Thank you.
Okay, great. So you heard from our panelists. We have a diverse and an interesting panel. So we'll go straight into it. I want to first start with the journeys that both Dr. Odundo and Yuna have walked. We'll start with Dr. Odundo. Just tell us about the journey you walked as you're preparing for retirement. What are the challenges you experienced? And yes, let's start with that.
Thank you. It's true that I was a regulator for the pension industry in this country for many years, and coming up with policies that are being implemented by insurance companies and a number of institutions. But when I retired, I found that that's not what happens in retirement. And therefore, I developed some 5 mantras which could help anybody who is retiring, and that's my experience. First one was post-retirement medical cover, which I found is the most important in retirement, not pension. Pension will follow down there. Because immediately you retire, you find that you've been covered for all those many years. I was lucky. Then all of a sudden this stops. And you find that retirement, another time you have problems with your body and many other things. So what comes first is post-retirement medical cover. And I'm happy that I was behind setting up this in this country. And the first person who got the first cover in this country from the insurance companies. So now there are about 5 insurance companies offering it. And I think it's a very good forum, because insurance is playing a big role in providing this medical cover. The second one is liquidity. It becomes very useful in retirement. You need some little cash, and that's where pension or drawdown comes in. And that you'll find that if you are employed for many years like ourselves, you find all of a sudden that salary stops coming in. And therefore, you need some small money to come in. Well, the only thing I can say is that currently what we receive as pension is very little. You need to do something. It's like 9% of what you have actually accrued. So if you accrue 10 million, you get about less than 100,000. So if your expenditure are beyond 20,000 or above, it becomes a big challenge. But however, it's important that you have at least something coming in every month and nothing. So pension comes in very important here, and that's why insurance company offering annuity or drawdown also comes in. So that plays a very big role in this area. The other third item that I put in my matters is don't go into retirement with a loan. It becomes very difficult for someone to pay a loan when it's in retirement. This I saw during my experience as a regulator, that people who went to retirement alone find themselves in a very difficult situation to meet the mortgage. And most bankers actually don't even give bank loans to retirees. Once you retire, they're very reluctant to give you a loan. So that becomes a big challenge. So don't go into retirement. The fourth item I put on my list is please start a business, something that will keep you busy. Because having been busy for more than 40 years, then all of a sudden you're not moving as you used to be. I think we're going to discuss realities in retirement much later. So please make sure that you're something you're doing, a passion. You don't have to do something which stress you, something you do without a lot of pressure. And the fifth one is please be close to your family. Most of us become very busy during our working life, no time for the family. So when you retire, you want them, they're not there because they are not used to you anyway. So it's important that you make point that you are close to your family, and I think that becomes very important. So those 5 mantras is what I might teach, and I take people through it. Thank you.
You know, what has your experience been? Do you have a mantra as well?
Thank you, Hazel. My experience in the retirement benefits sector has been from the time I got employed. From leaving school, I just started working in the pensions retirement benefits sector, and therefore I would say I have grown with it. The best thing that ever happened to me is to join an organization that cared to deduct from my salary and put money aside for my retirement. I did not have an idea what they were doing. As little as my salary was, it had to be deducted. And I think nobody should feel that what you are earning is too little for you to set aside something small for your retirement. Because of the compounding interest element, it ends up growing. The other thing is that you get used not having it, and it grows with your salary. So your contributions will continue growing as you continue growing in your profession or in your job. The other thing that I got to appreciate, and we need to appreciate, is retirement is not whether it will come. It is a fact. Indeed, it will, and it will happen. And because it is a certainty that will happen, it is important that we are all prepared for it, emotionally, psychologically, and even financially. Financially, because you get to appreciate when you are an employee, you earn a salary every month. That will stop with retirement. And sometimes it can come as a shocker. Number two, like Dr. Odudo has mentioned, it is usually a fraction of what you were earning. And therefore, if you can get to appreciate this right from the beginning, is to put aside an additional extra income or extra saving that can complement your retirement savings once you start retirement. The other thing is the advancement in age. It comes and it is a fact. The things that you used to do when you were in your 20s and 30s and 40s, you'll not be able to do them in your 50s and 60s. And therefore, your body that used to do all those things that you used to do, taking you to work, taking your children to school, and doing everything within very little thought time, you need even to think before you do those things anymore. Number, the next item that I would want us to appreciate is your need to be different when you retire. You could be still having dependents, and these dependents you used to support them using your salary, but now your salary has been reduced to a negligible or to a very small fraction of your salary. The other item that we needed to appreciate is that in as much as salary changes, your bills do not change. You still need to meet your fuel expenses. You still need to meet your rent if you have not made arrangements to have a house which is loan free. You will also need to meet your electricity and water bills, and therefore it is important to have an idea of what kind of a budget do you run on as a person, so that whatever it is that your pension will become, it should be something that you can live on and it can sustain you. I think that's what I would want.
So now if I may ask, now that we've talked about all the things that we need to have in mind, is there a right time to start?
Personally, I would say the right time to start is the date that you started drawing a salary. Whatever it is that you set aside for your retirement, don't ever try to consume it or to spend it and then save it. It will be very difficult. And that is why you find people put funds aside for retirement, and 5 years down the line, they want to have a reason to access those funds. But if you are not used to having them, you will not even remember those funds exist. So the earlier you start, the better. And I always tell my clients, because I interact a lot with them, especially the young people, the earlier you start, the better. And I tell them the right time to plant a tree is 20 years ago, so that 20 years down the line, you can have timber to build your house, or you can have fruits to harvest. The other best time to plant that is now. So if you have not started, the best thing is to make a decision and start.
Maybe just to follow up on what my colleague is saying, pension, you should start immediately. Immediately start working, what she's saying. And I'll teach this subject, a lot of people ask me, what point do I start thinking about it? I say, once you reach 50, start consolidating, start downsizing, start decluttering. Yeah, and that's the time you start thinking, going ahead, you want to start introducing your desires, because you'll find that you are owning pieces of lands all over which are not going to value. Some of them have been swallowed by water and they're hanging all over. So you must start thinking about it immediately reach 50.
Is that if there's someone watching this webinar today and they are 40, they are 50, is it too late to start?
I would say that once we go through this process, we tell them, okay, how much do you need at retirement? So that if they're going to get some boom, something from somewhere, then be able to put that money for retirement. Because you find that in this country, if you save, let's say, 12 million shillings and you put it in an insurance company, what you're going to get is very, very little. It's less than 10%, they said, which is like less than 100,000. So maybe they might have a lump sum. So you can always, because you see, at 60, the insurance company where you are saving the money, they buy an annuity. The money just used to buy something. So you might have kept it somewhere. So you can still buy that annuity. Yeah.
So maybe now let's look at the realities. That's what we're talking about, the realities of retirement. What adjustments did you have to make? Having come from a very structured day, every day, 5 days a week, what changes did you have to make?
I would say that it's interesting, having been, I was lucky to be in most of the very high positions, very busy, waking up at 5, coming back very late, and busy day in and day out, and too many calls, and you have to really push. You really push yourself. Then all of a sudden, okay, when you're on leave, it's different. But when all of a sudden it stops, then you realize that you have a whole day to yourself. And what I found interesting, and I tell people that for once I would find my spouse asking me, what's my problem for the day? Because she was still working. because she's not used to me sitting at home. Then you're left there with the housemaid and staying there the whole day, doing what? But at least I was teaching. Okay, so that becomes a big problem. So you must have something that will keep you busy during the day. I was used as a CEO to get about 7 newspapers every day for almost so many years, 40 years as a CEO of a financial controller. Then all of a sudden, this thing stops. Then I realized I really don't need all those papers. Maybe I need only 2. Then with time I realized I don't need them. Maybe I just go and check what they have been saying in the internet and whatever. It doesn't become very useful. So it becomes a problem once you reach that age. And my experience has also shown, and when I was at RDA, we discovered that people, especially people who have been living in high positions, they don't live very long after retirement. But what people who live longer are people, the teachers and such. You get used to this kind of life, but you all of a sudden you're going to go to the village, start a business that you don't know becomes a big problem. And as I teach this subject, I've met a number of student people who are mature and tell me, you know, my husband has become stressed. Why is he stressed? This man calls me every day, 10 times a day, which he never used to do. So he's becoming stressed. And all of a sudden, he also wants to take me to chamas because he has nothing to do. Women have a way of social life where they can meet with others and be together, but men don't have. We are so dependent all the way. So it becomes a big problem on men with social life, and it becomes a big challenge. And I've I'm recording a number of my age mates. There a lot of separation has taken place, or the wives have left and gone to America to stay with the children. So the children have been taken abroad. So the wife has reached a point now they are all gone. Many of them are gone. So this guy is left back at home. The other one I was talking to the other day. He told me that what he's doing is just talking to the cows. They give a cow a name, that one a name. And he's left alone because the whole family has gone. And I've been asking myself, why is there a big number of women going, leaving their husbands behind, staying with their children? Maybe she can help us when we get it. Thank you.
Okay, that's good. So as you're telling us about the change in routine, I think it would also be good to appreciate retirement from a woman's perspective. And maybe you can touch on what Dr. Odundo has said.
I think one of the greatest things that I appreciated is not waking up too early in the morning. Yeah, you rest and you wake up when you are ready to wake up. And I really appreciate it. Yes. Number 2, I appreciated being in my kitchen, because you realize because of the busy routine working schedule, you leave your house early in the morning, you come in the evening. There are things that you do not even know that happen in your house. Even making a meal for your family from the beginning to the end, it is something that I appreciate I'm able to do. You plan the meal and you execute. Earlier on, you could plan, leave it to somebody else to do it for you. Or if they are too experienced, they even take over the planning. So you find that you actually are almost a foreigner in your own home. And that is not only at home. Even in the farm, if you have a farm, workers manage their own things. They actually manage you also, because they also know when you come and they know what you expect. They make sure they give you what you expect. When you get involved, one of the things that you realize is they will run away. So you are left with your kitchen, you are left with your farm, and you have to start afresh, because the people you were used to working with, they were not used to that close supervision. They were not used to your style of doing things. So you have almost to recalibrate yourself and your life and reestablish relationship even with those helpers. I think it is a good thing, and especially when you have to rethink, you may even have to consider even relocating from the house that you have been living in. Yes, maybe move to a farmhouse, because even the costs and the expenses of operating that home are not few. So it is something that one needs to be aware of. Like Dr. Odudo mentioned, you think about even downsizing. Yeah, you realize the 4 or 5 bedroom houses, you might not need it with your spouse or maybe alone. Yes.
And from your experience, have you noticed that women are experiencing retirement different from men?
I think women are excited. Yeah, because they have found themselves being able to. I have a number of my friends who actually agribusiness. They grow their tomatoes, they grow their carrots, they grow the vegetables that they cook. They rear the chickens that they slaughter and feed the family on. So once it's actually the opposite of what he is saying. The woman will find herself with a lot of things that she needs to reorganize and do. And you actually you shift your management style from the office to your life. If you are doing operations, you change that operations and bring it to your home state. And you reorganize the workers. Some of them will appreciate, some of them will feel happy, and others will, some may not be too happy, and you be also happy to release them. Yes.
Okay, so maybe are there any misconceptions or thoughts that you had about retirement that were very different, like the experience of retirement and what you thought retirement was?
I think the younger me, I never visualized myself a retiree early along. And I remember I used to see my bosses in the office. And I could see them with the gray hair, and I was wondering whether those gray hairs grew when they were still there or they came that way. So you get to appreciate that this person joined that. He started actually working when he was young, and age has caught up with him. So that is a reality that actually dawns on one when it actually catches up with you. And now you have to deal with the issues that you are seeing them dealing with. Yeah.
What misconception did you have?
You see, the challenges that she's saying, which are true. We find that people, once you retire, if you go back to the way you used to work before, you find that first of all, you're very many new people, the agencies, they don't know you, so they're wondering what this old man is coming to do here. While you think you belong, and you start feeling, oh, I thought I built up this institution, and then you're really not part of it, and it causes a lot of feeling that, because some people are used to the institution, such that when they retire, they still feel they're part of it. Some people don't even know they're there because they hang around the institutions, which should not be the case. Once you go and you try and do something else. Yeah, I support.
Okay. I think it is also good to remain friendly, even to that institution. It helps you scale down your movement. Personally, because of continuing with doing insurance work, I found myself at ICA quite frequently. Once in a while, I meet the chairman. He says hello to me. And I just tell him I had come to look and see how the children are faring on. They are good.
And that's good.
Yes, and you feel appreciated. But as time moves on, like he put it, you get to the reception and somebody asks you, did you have an appointment? Yes. And you wonder whether that is a question that should be posed on you, but you remember it's an office that you need to respect.
Right.
No, I didn't have an appointment and I see so and so. So they are called.
So we've talked a lot about, and this is from your experience, about people in employment. But we know that a majority of Kenyans are in the SME space, are self-employed. From your interactions with them, I'm sure you have friends who have been in the SME space, you know, people who've been there. What is their reality with retirement? Because as an employed person, you know you have a date. When it gets to my 60th birthday, I am out of the door. But for them, it's a decision that they make themselves. So what do they think about retirement? Do they experience it the same way you experience it, or is it different?
I would say retirement does not exist. Just the way it did not exist for me when I started working. For them, it does not exist. And because nobody has gone to trigger them to think about it, and even to get them see the need, even to save for it, they look at life as a continuous routine. And when they think about retirement, it's actually something like sickness that makes somebody think about retirement. Or children growing, and they need to incorporate those children in their business. They do not see it that incorporating children in your business should be part of your retirement planning. So it's something that happens, perhaps because they are the ones who design the policies of their business, and they execute them, and they are left at that. So there is quite a bit of work that needs to be done.
Just to support what she said, when I was a regulator, one thing that we found out is that if you look at people employed, almost 90% are in the informal sector. So people who are being told 10% are also in this retirement space. So these people, 90% out there. So okay, we introduced the informal sector pension scheme, and a number of institutions, the insurance company keeps coming up with those kind of scheme which supports people in the informal sector. And like we have the insurance scheme, then a number of insurance companies will come up with it, try and inform them that this thing is necessary. And it's true that when you already work there, you are 60 and you already, as far as concerned, is not retirement. But then what worries me is the recently I saw a lady in Mamboga. She's been working in that kiosk like forever. She became sick. That place was closed. And for some time, I was very worried that something would have happened. But then when she appeared, maybe she was unwell. So you look at that situation whereby if she did share in the case we have a pension, I get sick. But if I don't go to class, I still get some pension which comes. But her, she doesn't have. So this education is necessary, and I think AKI should take it up and target them, because if they are able to even save a little, because when they are unwell, it becomes a big problem, and especially in old age, it becomes a very big problem.
Maybe now to continue with what you've talked about, issues of health, and we know the older you grow, your health issues are magnified, you become sicker, you become a friend to the hospital. Are there ways that even as I'm saving for my retirement, is it possible for me to save for medical separately, or just to be very specific that this money must go to this? I think you mentioned that your number one mantra was you need to have provision for medical care.
Actually, before I left, I used it in the pension scheme so that it's embraced within the pension scheme. So a portion of it, your contribution will go to a medical. And again, it was also being exempted from certain taxes. They idea to entice people to put money there. But only if they understand that when you become a certain age, the body doesn't really work the way you expect. And as a person who does the policy, I've gone through a few medical cases. I have COVID, and the spinal surgery, and cancer diagnosis, and all these were paid for by the insurance company. And I'm in retirement. If I didn't have it, it would have been a big challenge.
So, Paul, I think I'll come to you with that.
Yeah.
From the expert perspective, do we have products?
Yeah, and maybe just to pick up from what Dr. Dundo has said, there's the provision for the post-retirement medical scheme, which can be enjoined into your retirement benefit scheme. And the beauty of it is that there are taxes. Currently, what is happening is the tax exemptions that contributions into the post-retirement medical scheme enjoys is wholesome with what you enjoy when you're contributing into the pension scheme. However, even as an industry, we've actually been petitioning the Treasury so that we can actually have a post-retirement medical tax exemptions, very separate from your pensions, contributions, tax exemptions. And the truth of the matter is, Dr. Dundo talked of downsizing. You can downsize everything in retirement to an extent that your recurrent expenditures in retirement are less than your recurrent expenditures while you are actively in employment. But the only thing that beats this logic is medical expenses. Those are the expenses that are set to go up. Your traveling expenses will go down because you're not leaving your house every day, driving through traffic. Therefore, you're not spending on fuel. Hopefully, you have kids who've gone through school. You do not have school fees to pay. You have moved into your house that you purchased while you're in employment. Again, Dr. Lulu mentioned it, and it's true. Every mortgage financier will be looking at your age of retirement, and if they're giving you a mortgage, they will tie the term to the date when you retire. Now, what that means is by the time you're getting into retirement, you have a home, so you will not be paying rent. And no bank will want to touch you unless you're going into a circle where it's a mutual environment between you and your peers for loan purposes. So post-retirement medical schemes is one thing that everybody should actually be looking at for purposes of comfortable retirement.
Okay, so let's go back.
Maybe just to follow up on why post-retirement medical is important. One thing, I took a joint cover with myself and my wife, so that if anything happens to her, I mean, when she's sick, she can go to the hospital. She has her own card, and I'm on my own card. And it becomes easier when you go to any hospital, they'll accept it like anybody else. That's a joint cover. The same with the pension, it's also joint, like that if anything happens to me, she continues getting the benefits. It's a lifetime payment. And what I took for medical was a lifetime payment, paid one lump sum. I don't pay monthly or yearly premiums.
Okay. So if you go back to now, people in business, one of the things that I think it's a Kenyan thing that we like to say. I am very little. I can't possibly say. I think that is also coupled with our very poor saving culture. But are there options for small business owners, for people who are within the service sector, to save for retirement? Are there options within the insurance industry?
Certainly, yes, Hazel. There's quite a bit of options that are available. And in fact, I want to start by saying savings is not preserve of a certain clique of income earners. Anybody who earns a saving ought to, or rather who earns an income ought to save, and especially for retirement. I think if you go back, there's a book I read a while back called The Richest Man in Babylon. I think it's set in the 16th century. And that richest man in Babylon, one of the things that he was talking about is saving for retirement. Well, maybe not in the same exact words as we're talking about it today, but that is what it was. And in fact, it was very prescriptive. And he talks about saving 10% of every income that he earned. Let's go back to the issue that you raised, where we're talking about levels of businesses. What happens is, and I'll go back to what one of the panelists mentioned, we have income and then we have salaries. I actually want to challenge us that the moment you have any income, you should start saving for retirement. And this is where now we're talking about you who has a job and a salary, but is giving a stipend to your child. You should be teaching them how to save, because that is when, because later on we'll be looking at some of the statistics, some of the numbers that we can work with. Those numbers work well because a lot of that data that we're given, for example, financial planning pundits say, save between 15% and 20% of your salary, or rather of your income, to build a proper retirement nest fund. This assumes that the moment you started getting any money, you started saving. It doesn't mean that you were age 26, you got into employment and you start saving. If you start saving at 26, you'll be playing catch up. And playing catch up, as Dr. Pinto said, is quite expensive. Somebody who wants to start saving at age 40 is very different from somebody who wants to start saving at age 18, for example. So when you get your HELP loan, there is what you use for upkeep, there's what you need to save. And I know it's very difficult to conceptualize, but the idea is, if we are, and if you listen to a lot of the financial pundits, what they say is, you should spend less than what you earn if you are to save, because you cannot spend and save after spending. There will be no money left. I know we talked about, Yuna talked about joining a company that was gracious enough to have a pension scheme. What that company did was they had an automatic enrollment. And that is because human nature, we love immediate gratification. Nobody wants to talk about deferred gratification, which is what pension is. So today, if I was earning 100 shillings and I put aside 10 shillings for retirement, what I'm doing is I'm deferring my gratification to retirement rather than enjoying the gratification today out of that 10 shillings income that I'm putting aside for saving. When you throw in the idea of compound interest, which is the eighth wonder of the world, it's fantastic because it means you're earning interest and the interest that you earn is also earning you interest. So again, that is something that we want to take advantage of. When we're talking about returns for themselves, pension investments are in two fronts. We have what we call discretionary mandates that are done by fund managers, licensed by CMA. What they do is, as a client, you will give them the authority to actively manage your fund, and you will enjoy the ups and downs of whatever it is that they do. Then we have the guaranteed investment mandates, which are offered by insurance companies, licensed by IRA. What they offer is an investment guarantee where, yes, you give them the leeway to invest the money any which way they deem fit. But in the event that there are losses, there's a minimum guaranteed return that they're giving you. So if you are someone who is very risk averse, and I would want to encourage us that we actually, on our pension savings, because these are long-term savings, you don't want to go very aggressively into investments so that you are then exposed to the vagaries of the market. You know, the ups and downs of the markets are hitting you every day. You heard that yesterday there was a good deal in the stock market and you put your money in there, and then the following day something happens and you're losing that value. That is not how a pension investment really ought to work. So while you're choosing your scheme, you want to be very careful that you're going to be getting consistent and returns that most of all are actually beating inflation. Because again, if you're investing money and you're earning a return that is less than inflation, you're actually losing value on that money that you're putting aside. To go back directly to what you asked, therefore, in my opinion, every person, SME, small or large corporation, even entrepreneurs as individuals, ought to save for retirement. And the beauty is when you're an individual or when you're an SME, there are options that make contributions voluntary. When contributions are voluntary, the issuer of, say, an individual or a personal retirement benefit scheme, well, because it has to make sense even for you as a saver. I know in the industry we prescribe some minimum contributions, but the schemes are so flexible that in those instances where you feel your income cannot sustain contributions into the scheme, you can actually go into a contribution holiday. But the funds that you have saved continue to earn you a return. And again, the beautiful thing about pensions, and this is regulated, it's not a favor that anybody is doing, is that contributions that you put into a pension scheme go in tax-free. So you'll be saving on taxation, while at the same time, you'll be getting returns that are tax exempt. So it's a double saving for you when you go into a pension scheme.
All right. So somebody watching this webinar tonight, and they are in the SME space, or maybe they're even formally employed in the formal sector, and they would now want to put aside their 10%, their 5%. Where would they start? Where do they go?
Okay. I think the first step, which is very important, and it speaks to what both Dr. Dundo and Yuna has mentioned, is first of all, we need to establish what our income is. So you consolidate all that is coming in so that you know what you're really worth at the end of the month, and then using that, and of course, doing your budgets and seeing what needs to go out, which is mandatory to go out, and please put in pensions contributions as the mandatory bit that needs to go out. Then the next thing is you assess what sort of retirement you want. Eunice talked of when you're in the farm. Now, if you're somebody who is envisaging being in the farm, you must have the livestock or the crops to be tending to. That takes money. So if that is what you're looking up to, you need to establish how much will I need to set it up. And the best thing actually to do is set it up before you retire, so that you're not using your retirement benefits to set up whatever it is that you want to do. Probably what Dr. Lungo failed to mention, which I think he will mention because I've already mentioned this several times. At the Retirement Benefits Authority, they've also done studies. And one of the things that is very consistent every time a survey on retirees is done is that businesses that are started by retirees, about 3/4 of them collapse within the first few years. But why is this so? I've been an insurance practitioner for probably I started at the age 20, I'm retiring at age 60. 40 years I've been doing insurance. I leave employment and then I want to run a matatu, which is a very different ballgame. Chances that I will succeed in it. And then remember, why my employer is letting me go is because my energy levels have gone down. So I do not have that much energy to put into that business as I would if I started it earlier. However, there are things that you can start in, and Dr. mentioned, and which is true. Studies again have shown those who start their businesses while they're in employment, and you'll find that mostly within the lower cadres of employment, not within management. Management, they're very busy in boardrooms and everything to run a business. So those businesses tend to thrive better. In fact, you'll get a messenger who had some poultry, retiring and taking a bit of the lump sum benefit that they're paid and plowing it back in that business, making himself much more money than the manager who got out of employment and started a poultry farm. So those are some of the things that we really need to look at. Now, after you've assessed what's your retirement, what the kind of retirement life that you want to have, that will determine how much you need to save. Then you can talk to any one of the 18 insurance companies under AKI that actually provide retirement benefit solutions, plus any other financial advisor that you can actually find who's credible. They will take you through what your savings culture and what your savings plan should look like. With that, then you can be able to properly set up a retirement benefit scheme that will work for that will be fit for your purpose. Lastly, what you ought to do is that annually you need to be reviewing this plan. You need to be looking at your statement so that you know how well it is building against the assumptions that you put in, so that you know what to adjust. Because you could have built a plan that has a return assumption of 12%, whereas the actual returns are 8%. That means then for the following year, if you can, you need to put in catch-up contributions to bridge the gap if still your intention is to live at a certain, at the same lifestyle that you wanted. The other thing that you need to do also is even the desire of how to live in your retirement could change. Maybe you're one person who never wanted to travel, but then one of your daughters, one of your sons took you for a holiday and you realize this is such a beautiful thing. I want to do it when I retire. I want to see the world. You need to plan for that. So it needs to be an ongoing, very dynamic plan that you have. Yeah.
Okay, so maybe now let me come back a little. It sounds very nice and linear that we're talking about save 10%, 5%, but life happens. Challenges crop up. Someone has actually sent a question and they're specifically asking about black tax. How do you deal with these challenges that keep cropping up, yet still maintain the discipline to keep saving, maintain the discipline to not go back to that pot and ask for money? I'll pose this to Dr. Zigo and Yuna. What has your experience been?
what I would like to say is, if first of all, you should treat saving as an expenditure. Treat saving as an expenditure. The way you spend some drinks, whatever, and because you set aside money for food for what, that treat it just like an expenditure, not some money which you're going to touch. So if you treat it as an expenditure, you know it's money gone and you don't think about it. That gives you that feeling that you should move on. And as this question comes, and I always get people say Kenyans are suffering and they don't have money. So where do they get money to save? And then you ask yourself, okay, you have some expenditure that you don't want to do. Where can you reduce? Because you're talking about the future. No, very few people are not interested. And it's something I think AKI should take up. This financial education is critical. They should come in as a pool, not competition. Forget about the competition among them. And say that we put money here to educate people in SMEs and young people in schools. Because when I was doing this education, you'll find if you go to the Nairobi show, when students are walking around, the first place they go to is Central Bank, because they see money. Then they go to Nairobi Securities Exchange. Then insurance, pension is the last one, because I think that's not important. And we go on the same line, and you could be maybe the first one, but they'll still close and go to Central Bank first. Because they want to invest money. That's what they're seeing. And because a lot of education has gone into this. So I think they actually should take it as this, because they're the mother, bring them together, say we need to educate people in this area.
I think if I were to add on to what Dr. Odudo has put, saving should take priority and also budgeting. The black tax that we are talking about is the monies that you have to pay and you had not planned for. Incidences happen within society, among your friends, in church, all over, and you need to put in something to assist. And now you have become even more a social person because you are available 24/7. The best thing I would recommend is to have a budget. We were just discussing it with some friends, and somebody, actually, he is retired like me, and he said you budget even what you spend for black tax. When it is exhausted for the month, you just say, I'm sorry, I'll not be able to participate at the moment. But I think one of the things that you should avoid doing is going to your savings, which you have put aside for your retirement or the emergency fund, to handle the black tax. Because what essentially you'll be doing, you'll now be making yourself subject, just like whoever needs the black tax support, you also become one. And I don't think two blacks will help each other. So the best thing is have a budget, share whatever you have, as long as those needs arise. And the moment it is exhausted, it's over. Next month, they'll be there.
Yeah,
so
currently what you say, Kenyans are actually, if you look at all of us, in our subgroup, you're being put in our subgroup to pay some funerals. So the kind of money you send to about 5 people in a day, here you're not ready to think about saving, but your money you're sending around is so much. You never planned for it. Every day you're put in a group. So even if you give less, they think you are not committed. But you are sending to 10 people. So people need to think.
And I think if I chime in on this, Hazel, and especially the idea of dipping into your retirement benefits, not just for black tax purposes, but for any other purposes, because we see that a lot in the course of our practice. Somebody gets a new job, and a new job almost always means you're going to get a better remuneration wherever you're going. But then they're very keen to draw out of their pension benefits. Now, what you're doing really is you're misusing the purpose of a retirement benefit scheme, because just as the name suggests, it's a saving you're putting aside for retirement. Resigning and going to another job is not retirement. That is resigning. And unfortunately, a lot of times when this happens, it is money that goes into consumables, things that are not very productive. I'll give credit to those who put money into very productive uses, but a lot of it goes to consumables. If today I was to leave my employer and I'm joining AKI, maybe what I want to do is I want to look sharp the first day I come in. What do I go? I'll go to an Italian shop and buy a suit. How does that help with my retirement? Because I was going to earn that salary at AKI anyway with this suit on. So how has that helped my retirement? And yet I've used my retirement funds. So what I usually say is keep retirement monies for retirement. If you can't, then definitely you will come for it. But one other thing that you ought to be very cognizant about, the moment you're drawing out retirement benefits before you retire, even the tax treatment of those retirement benefits is very punitive. And it is with a purpose. You are supposed to be discouraged from drawing out these benefits. And lastly, on that matter, when you budget for retirement, as my panelists have said here, then you stop thinking about it as that pot of money that is available to you because you're not retired. You will figure out how to pay your black taxes if you have to, because fortunately or unfortunately, that is our society. But again, you have to do it within moderation. I really don't think if you forgot that you had food in the fridge and you're hungry, you remember to go to the fridge. So just forget about your retirement benefits when you save it.
So what would then your advice be to somebody who has had, let's say you worked for 10 years and you've had 3 employers and you've been lucky enough to have pension, retirement plan in each of them, and you keep moving. What would your advice be? Do I leave it there? Do I even forget that it's there and move on to the next and on to the next or on to the next? Is that the best thing to do?
The best thing to do in such a case, because again, our laws are very generous on that. Retirement benefits are very portable, so you can move your retirement benefits. The beauty is when you're moving your retirement benefits for purposes of consolidation, you actually move them tax-free. So if I remove it from scheme A, to manage when they're all together, I'll actually move those funds tax-free. So what we encourage our members to do is, and because again, if it is about employment, if you retain your funds in your employer scheme, administratively it becomes very cumbersome because a lot of times when you come to me as a former employee of AKI, I will ask you to come through AKI. And depending on how you left AKI, sometimes you might not want to come back to AKI. So we advise you, what you do, Hazel, you're resigning today, open up a personal pension plan, then we can transfer those benefits into the personal pension plan because now that is a contract between you directly with the insurance company, not through your employer. So consolidation is what I would advise.
And as you're on that, there's somebody who has asked a question here about that they're expecting a gratuity. So what's the difference between a gratuity and a pension or a retirement plan? And so how can they use that gratuity to help them with the retirement plan?
By definition, a gratuity is a severance payment that an employer gives you as a benefit, as an end of service benefit.
Okay.
Yeah. So you have worked for an employer for X amount of years, your salary was so much, therefore your gratuity is a function of the length of service and the salary that you earned through your service with that employer. It's typically available to you as a term of contract. So if it's provided for in your contract, then you'll be eligible. For those unionizable members, a lot of times it's a term within the collective bargaining agreement. The purpose is financial support as you transition from employment, loosely put. A pension, on the other hand, is a very structured savings where you join a pension scheme, and the expectation is you're consistently contributing in a very structured manner into this pension scheme. Your contributions earn you a return, so that there is also the idea of growth when you're in a pension scheme or a retirement benefit scheme for that matter. So this growth then means it is not just what you're putting in that you get, it is actually what you put in plus the income that it generates for you. The primary goal is to provide you with financial security in retirement, because it should only be payable, or it should ideally only be payable when you're retiring. Yeah.
So if, for example, I have worked for 10 years with AKI and I've decided I'm leaving and AKI decides to give me a gratuity, is it wise for me to put that gratuity in another savings account, or can I now open a personal pension account and then it now gets into that system and it starts earning money? Would I consider that wisdom?
Yes, our pension laws are quite progressive. So much so that there is a provision within the Retirement Benefits Act where you can actually transfer a gratuity payment into a pension arrangement.
Without attracting tax.
Yes, and that is the beautiful thing about it, because on your gratuity, because it is treated as part of your final salary, it is most likely going to attract a tax of 30%. So if you have 100,000, yes, if you have 100,000 of gratuity, you're most certainly going to pay 30,000 shillings as tax. So what comes back to you is 70,000. But if this gratuity has been earned over years, you can actually spread that amount back so that it qualifies for tax exemption. And a lot of times you find that you're transferring your gratuity without any taxation into a pension scheme, so that then it forms part of your retirement pot and it starts earning you. We also say that where the gratuity arrangements, if possible, you actually convert them into pension arrangements, because remember, gratuity is a very linear arrangement. How many years you've worked, your salary at the point when you're visiting, and that is what gives you your gratuity. There's no function of growth in between. Yeah.
Right. So I think there's now you're getting to, I have been saving all this money. First, number one, this is Kenya and things happen to people's money. How sure am I that I'll get this money I've been saving for all these years?
Good question. It's a question we encounter quite a bit in our administration process, as we talk to clients, as we talk to companies, trying to engage them to sign up for these pension schemes. I'd like to first start by saying pension investments within the insurance space is done by life insurance companies. Life insurance companies are modeled around what we call the life statutory funds. Life statutory funds are so protected in the Insurance Act that they can only pay liabilities that are attached to them. So what we are required as insurance companies to do is every quarter to our regulator, the Insurance Regulatory Authority, we submit returns. These returns shows what liability. So if Hazel has given me 100 shillings of her pensions to manage, I have guaranteed 5% return. So at the end of the year, in the minimum, Hazel is sure of 105 shillings. The Insurance Regulatory Authority expects me to have assets that support these 105 shillings 100%. So that is why we do our returns on a quarterly basis to the regulator. The beautiful thing about that is there are times when investments go up and down, because remember, we also, as insurance companies, invest in the stock market, we invest in bonds, we invest in property, and there can be unrealized losses, which makes your assets less than the liability that you have. In English, the assets that you hold on behalf of the clients, on the behalf of the liability you have for the clients who have subscribed to you for pension purposes, are less than that liability. So you are said to be in a deficit. The Insurance Regulatory Authority will give you a duration of time where you do your remedial action to make sure that you're showing up your assets to be able to cover that liability. Now, the beautiful thing is, when anything in the unfortunate event of an insurance company winding up, the liabilities for pension schemes can only, or rather, the statutory fund where the pension schemes belong can only pay liabilities of that pension scheme. So if there's a supplier who supplied tea to the insurance company who needs to be paid. That is money that would not be paid from the pension fund. And I like giving this example just to give it context. The Kenya National Insurance Company collapsed at some point, but there's not a pension scheme that lost money when that company collapsed, because the assets of that company, when they are realized, the first people to be paid are pensioners, first line creditors. After that, it's pension schemes. After that, it's those who have life insurance policies. And then in the case of general insurance companies, by the time all this is happening, probably there would have been nothing. But now we also have the policyholders compensation fund that comes in to compensate those who have general insurance policies. So for purposes of a pension scheme, if you're investing in an insurance company, know that your investments are 100% guaranteed.
I think also just to add on to what Paul has said, on the part of Kenya National Assurance, there are those people who are drawing a pension, regular annuity from the organization. At the point where it wound up to date, if they are still alive, their pension will still be paid because it is protected. Yeah.
So it's guaranteed.
Yes.
Guaranteed I'll get this money.
The government is very, very
Strict
much
on
on that.
Okay, I guess that's a good thing. So now I've saved all this money. I have reached retirement age, or I've been in business and I've been saving, and I've now decided I want to sit down and relax and not stress some more. In what ways now will I access this money that I have saved? Will I go and just say, "Hi, give me my money," and give them one big check, or how does it work? I'll start with Dr. Odinga. Now you've had that experience.
Yes. Personally, when I was retired, I decided that I should go an annuity rather than a drawdown. Because an annuity is a fixed amount or indexed, but you don't get, once you buy it, it's the business, they pay you every month. A drawdown, maybe she probably explain, it's like you deciding and live for 20 years. So you divide the money over 20 years and you start eating it. When you go broke, you go back to the insurance company and ask for more. And they can give you, and it becomes a big challenge as far as I'm concerned, but they can explain. Because once you do that, and I tell people, when it comes to the gratuity or the lump sum, don't put everything in pensions. However little it is, spread your risks, because there's no way where the risk are 100% secured. I said, put some money in bond, maybe right now it's almost 18% or something like that, and you earn it for about 8-10 years. Put something in annuity, put something in post-retirement medical, and pay off your small debts. So that you spread the risk than putting it all in one insurance company and then tomorrow you the company has collapsed.
So I'll come back to you. Explain to us what those products are, the annuities, the income drawdown, and how do they work?
So if I take it from the top, how you access your benefits is really a function of how your scheme, the scheme you are a member, is designed. There are mainly two types of schemes: a pension scheme or a provident fund. So a pension scheme demands that you get a pension out of the scheme. But the pension laws also allow you to take a lump sum benefit from your accumulated benefit. So currently what the law allows is you can take a maximum of 1/3 of your accumulated benefits as a lump sum. To put this into figures, I have accumulated 30 million in the pension scheme. I can take 10 million as a cash lump sum, of course, subject to taxation. Then the remaining 2/3, I transfer it into a pensions arrangement through an annuity or an income drawdown, and we will talk a bit about that. If you're in a provident fund, you can take 100% of your benefits as a lump sum. But depending on if you are Dr. Dundo, I know what you do is you assign a bit of it to an annuity because it's acceptable. You must not take the 100%, but the law allows you to do that. So you can choose what portion you want as a lump sum and transfer the balance amount into a pension arrangement. So under pensions arrangement, the industry currently has two options. You have an annuity, which is a guaranteed savings product, if I may call it that. You take your money, give it to the insurance company. The insurance company then undertakes to pay you a certain amount of money depending on the variabilities that they plug into their pricing for the rest of your life. So it pays for as long as you're alive. So that's the
So
beautiful
every
thing.
month.
Every month or every
Month.
quarter or every year, depending on how your installment schedule, you'll get that installment. You can also index it, maybe to increase every year by a certain percentage if you're very cognizant of inflation. You may want to say that I want my installments to be increasing by say 5% every year, just to take care of that inflationary aspect of the capital markets. So the beauty of that is then you have transferred the risk of you outliving the benefit to the insurance company. I know there are annuitants who are over 100 years old and are still drawing their annuities from the insurance company that they bought the insurance, the annuity from.
So what happens if I die? Okay, so the moment I die, it stops coming.
It stops.
Okay.
So that is the primary structure of an annuity. But again, a question is probably going to come up. What happens if I give the insurance company my 20 million and after 2 installments, I die? What happens to the balance amount? And that is where now, when you're structuring your annuity, you need to price in what we call a guaranteed period. So what this guaranteed period does is that it ensures that you're paid irrespective of you being alive or dead. The annuity installments are paid up to the end of that guarantee period. But if you survive after that guarantee period, you continue earning.
Okay. So it doesn't stop just
It doesn't stop because you're dead. And a lot of times, when you're talking to your financial advisor or your annuity issuer, they'll be very keen to ensure that by the end of the guarantee period, if your purchase price was 20 million, you'll have received back 20 million in terms of installments. So that anything you're receiving after the guarantee period is a profit to you as an annuitant. The other option is the income drawdown. Now, the income drawdown is where now you as a member, you're actually taking that longevity risk, the risk of outliving the accumulated benefits. You're taking it head on. So you're saying, I have 20 million, and from my 20 million, I want you to pay me 12% of the outstanding amount every year, with the hope that you'll be generating more than 12% return on the benefit, so that your benefit at least does not diminish. Now, in the unfortunate event that what you're drawing out is more than the return you're getting, then obviously, even without doing the mathematics, you can already see that the amount that is outstanding in your account starts reducing.
So if it's like a savings account where every month.
Yeah, you're drawing out. Yes. Okay. So at some point, you're going to you're actually going to extinguish that account because you'll have drawn the last cent. And at that point, the issue of the income drawdown contract says goodbye to you. So you're on your own. So that is the main difference between an annuity and an income drawdown.
So an annuity I'll earn until
for the rest of your
income
life.
drawdown is
Until you grow it to
minus until it gets to.
Yes.
Maybe just to add, you can modify the income drawdown arrangement and put it for a given period. If it is 10 years, 15 years, and by that time you'll have whatever it is that will be left, there will be a residual fund. That residual fund, remember, you'll have increased your age by 10, so you'll be at around 70. So you can use whatever the residual funds there are there to buy yourself a small pension.
Maybe just to put context to what she's saying, the current regulations require that an income drawdown must run for a minimum of 10 years. Now, after 10 years, you have the option of drawing out the remaining balance as a lump sum, or continuing with the drawdown as it is, or converting it into an annuity. And now the beautiful thing, as she says, annuity is age-weighted. It's very sensitive to your age because it looks at your mortality rate. So the older you are, the better the annuity rates that you get. So matters remaining constant. You have somebody who's 70 years old, they have 20 million. You have somebody who's 50 years old, they have 20 million. If they presented themselves for an annuity using terms that are same, other than the fact that they are of different ages, the 70-year-olds get a substantially better value for an annuity than the 50-year-old.
Maybe a question to Paul. At what point does a drawdown pensioner realize that is, I'm seeing in a pensioner you're expecting some fixed amount every month, but I've seen situation where you've been told that your pension has reduced. How does that arise? And in your mind, the pension should never reduce.
Yeah, what happens in an income drawdown is the regulation also stipulates that you can only pay out a maximum of 12% of the outstanding fund within any 1 year. So if you pick the maximum amount of 12% for the first year, so you had a fund of for ease of calculation, let's use 100,000. So you put in 100,000 in an income drawdown fund, you picked 12% of it. So within the year, you have withdrawn 12,000. At the end of the year, and the return you get out of it is less than 12%. So at the end of the year, you actually have an outstanding balance that is less than 100,000, what you started with. And therefore, when 12% is applied on this 100,000, it is a lower figure. So that is why in an income drawdown, it is a possibility that your pension for the next year actually goes down.
Actually, income drawdown is a
reducing balance.
Yeah.
pension, you can have it increase because you can factor in escalation.
Yeah.
Escalation factor.
Or it can be.
Yes, and
Or
it
it
can
can
be
still
level.
go.
Even
But
when,
you
even
choose-
when they work it out, you'll find that if you take a fixed and an indexed one, an indexed one, you'll find you get a lower amount than a fixed one.
Yeah.
You start at
At the beginning for an index one, you get a low amount and then it increases with time.
Okay, so let's go back. I think there's a question that has come here, several questions around the post-medical retirement fund. I think Paul just explained to us. I have started saving today, and I also want to save for that post-medical retirement. How does it work?
The post-retirement medical is a product that is enshrined in the Retirement Benefits Act, and it is meant to help pension scheme members put in additional contributions towards medical insurance or medical care in retirement. Because one of the main headaches for retirees, as studies have shown, is actually medication in retirement. So as a member, you are eligible to put in additional contributions so that as you save for your normal retirement pension upkeep, you're actually also saving for monies that will take care of you for medical purposes.
So let's say I was saving 20,000 a month.
Yeah.
And that was standard. I think that's what is also acknowledged by law.
Yeah.
That is tax-free.
Yeah.
So over and above that, I now put in maybe another 5,000 shillings that will go towards a medical fund.
Yes,
Okay, so it's separate from this 20,000 that I've
it should be, and it should be accounted separately so that if you're getting your benefit statement at the end of the year, you actually see how your post-retirement medical scheme is performing or account is performing, and you're seeing how your retirement benefits account is performing.
And are the rules the same?
The rules,
Guaranteed income.
now the guarantee of the income depends on where you are in, where your scheme is invested. If your scheme is invested in an insurance company, or the provider of the scheme is an insurance company, then there's a guaranteed investment. Now, something else that is also important is at retirement, if you feel because this came after the Retirement Benefits Act, it's an amendment of the act that came much later. So you could have been in a scheme you're saving, but at the point when you're retiring, you've saved marginally because you started saving late. You're actually allowed to transfer your pension benefits to your retirement, to your post-retirement medical account free of tax, so that you then apply it for medical expenses in retirement. So that is also another benefit that scheme members have
Maybe to add to what he's saying, I as much as I was behind the introduction of this, the time I was leaving, I was 59. Therefore, I could not have raised that money. What I was to do was to use my gratuity for that purpose to buy the pension. And for young people, they can start contributing now, so that by the time they reach age 60, they've accumulated what they need to buy a medical policy. There is a bronze policy, there is a silver policy, there is gold, and platinum. And one is 1 million, 3 million. Inpatient,
It's annual.
monthly, you can be contributing monthly. In fact, the table is very simple that if you are 20, even if you go for platinum, you will pay about 1,200. But consistently for the next 40 years.
Okay.
So that by the time you reach retirement, you stop paying. And it's enough.
The earlier you start,
Yes.
the better.
Yeah, so that by when you reach there, you start now, it's what I took was accumulation of 2.5 million. You get a 5 million inpatient, 20,000 outpatient.
And was that a one-off payment?
That was a one-off payment.
For 1 year?
Yes, because
Yeah, because it was starting
I just paid
at
it.
age 59.
I just paid it from my grant.
Ah.
It was not 1 year.
So now I have saved. I am now 60. I have been saving separately for my post-medical.
You can buy the policy.
How now does that work? I just take the money from there and
You go to an insurance company, just like the way you buy even pension. Because what normally schemes do, they just accumulate money. But at the end of the age of retirement, they buy policies from the insurance companies for life, for pension. So you can, if you don't have that lump sum, you go to the provider or post-retirement medical, and they say, I want to buy a medical policy. They do the usual duty years, medical, whatever. Then you can buy, because I bought it at 59.
And is it possible for me to buy the same way, like, can I give them one lump sum and then
Yes.
I'll never pay for medical
There's one,
insurance?
yeah,
again? I think you
if
said that.
you let's say put 2.5 million, then they say, okay, maybe your medical now, they'll work out because they know that will be adding some interest and it's enough to pay that annual premiums. And then,
So basically what you're doing is you have a fund
yes,
of, like he says, 2.5 million. And then you have this medical expenses risk that you want to take care of with the 2.5 million. So you transfer that risk to the insurance company. So you give them the 2.5 million, then they tell you, every year we'll be covering you to this extent
And for how long?
for the rest of
for
your
the
life.
rest of your
Because
life.
it is a single lump sum.
Yes, a single lump sum, they've worked it out. So you find that every year they work out what they pay to the company, to the insurance company,
Yeah.
and you get a full cover. So even if you go to hospital and you find your medical is 3 million, they'll pay. And doesn't mean the following year they will not pay because you are covered that year fully.
So much in the same way as your regular medical scheme that you pay for annually. This is a single lump sum policy that you pay for when you're purchasing, and it covers you to the extent of the limits every year. So his example,
So you said
you have-
limits
yeah,
before.
the limits are set.
Yes, yes.
The limits are dependent on how much money you have for the purchase. So if you have X amount of money, and then they will tell you that these are your limits. So what you need to do is you need to be very cognizant as you visit the hospital that you're not breaching your limits, because the moment you hit your limit for that year, then they cover for that year.
For that
You
year.
know, yeah.
For
But
that
then,
year.
for that
yes,
year.
but when the year comes, then now you
If
have a
nothing,
new
happens,
limit.
if nothing happens to you, then you have a new limit.
Yeah.
And again, the limit is not 5 million. The limit starts with 500,000. You can take an inpatient for 500, for 1 million. And inpatient is very cheap compared to outpatient.
Yeah.
It's almost a quarter.
And then now, so this money comes from this
Post-retirement.
post-retirement medical scheme and goes directly to the medical insurance
Yes.
company.
Yes.
Okay. I think that is answered. I think other questions that are coming in is it possible if I was on a pension fund and once I leave the employer or I retire, I move my pension to an IPP, can I change it to, can it change to a provident under IPP?
The rules on transfer are fluid on that. However, and I know what the authority has advised for is that at retirement, the provision of a transfer of benefits is actually not there. And you're either just paying the benefit or you're leaving the benefits invested in that scheme. Because again, one of the things that those who want lump sum payments do is that at retirement, I purport to transfer my benefits to a provident fund, and immediately they go into the provident fund, I am accessing it as a lump sum. So that is why they're trying to really clamp onto that because it is a navigation of the law.
Actually, the rule is if you are transferring from a pension scheme, when it goes to the personal retirement arrangement, it should also be put as a pension, not as a provident fund. If you transfer a provident fund, it should be invested as a provident fund and a personal retirement, just to close that gap.
Okay, so I think we can take the last few questions because it's now 8:20. Let's just finish. So somebody has asked here, shed some light on monies or amounts that have been transferred to the unclaimed financial assets authority from pension fund due to inability to trace contributors.
Yes, the Unclaimed Financial Assets Act requires that when you cannot trace beneficiaries, you transfer whatever monies that are payable to those beneficiaries to the authority, so that the authority then takes care of the repatriation or they look up for those beneficiaries, or when those beneficiaries show up, then you can then direct them to the authority to get the benefits. This happens if, because what the Act provides for, if you cannot trace a beneficiary for 2 years after the benefits were payable, then the monies should be transferred to the authority. What we do is we encourage members to actually update their details so that their monies are not transferable to the authority, because the process of transferring those money, of accessing the money once it is in the authority, is a bit tedious. And especially in the event that a member has the direct beneficiary is dead. It will require things like letters of administrations, which come at a cost. And a lot of times, some of the benefits that are even transferred are less than the cost of getting this administration letter of administration. So therefore, it means, in a sense, as a member, I labored to save, and then unfortunately I passed on, but my services have been forfeited to the state because my beneficiaries will not want to go through the process of accessing these benefits. It will cost them more than the benefit that they're going to access. Therefore, one of the most important things is members to update their profiles, so that if we're talking about beneficiaries, let the beneficiaries be well spelled out, so that any trustee of a scheme knows who to pay in the event that you're not there. And you as a member, keep track, and that is where now that consolidation we were talking about comes in. If I have my benefits all over the place, personally, it could be a challenge to try and trace the benefits. Now, who and to my beneficiaries, if my benefits were all over the place, and I am not even there to guide them. So again, consolidation is very important.
Okay.
And just what you say, what I found out among ourselves, most of us don't write wills. And most of I've gone through a number of training, and every time I ask how many people have wills, 1 or 2, even up to the highest levels. And that is where one of the problems starts, because we don't write wills. And I think it's time that we encourage our people to write wills. If you don't disclose it, can be kept in a closed socket, lawyers, whatever, and then released. And then it's easy to know where your incomes are. For some incomes, people don't know. Especially most of the amounts which go to unclaimed assets, people don't know. Although there is a way, I think they came up with a system there where you put your ID. You can be able to know that you can actually find out some that even dividends have been paid and taken there, and you are around. And they're saying they don't know where you are.
Yes, if you don't claim dividends after 2 years, they are sent to unclaimed assets.
And they say you're not there, and you are around.
Yes, because
and maybe just one more thing about this, the idea of wills. Will is part of estate planning, where I put in retirement planning as well. And there's a talk I attended, which was quite eye-opening. You don't need to have a 7, 8, 10 figure amount in terms of wealth for you to have a will. And the person who was presenting this said it as simple as anybody who has an M-Pesa account at any one time, whatever money you have in that M-Pesa account can actually go into your will for whoever will receive it in the event that you die today. Because otherwise then it ends at the Unclaimed Financial Assets Authority.
Great, so I want us to now wrap. We'll just take the last round of maybe your message to Kenyans who have been watching and have stayed with us up to this hour, which is 8:25. Thank you very much. We are 25 minutes beyond time. So just closing remarks and then we will wrap up. I'll start with Dr. Bindo.
Thank you. I think one thing I always say, I've come up with the 5 mantras, but people can add anything else. It helps in a way. And this is education process that is continuous. And we think we need to put people on this. The question she never answered, why the ladies are going to abroad and leaving the men behind. Maybe she'll answer it now. Thank you.
Linda?
I am not sure why ladies are going abroad, but any animal would need a change. So in that they have brought up their children and they are giving them right ground for taking that opportunity and enjoying the change. And of course, now the other person has come home. Now that is the constant. They want to have that change from the constant and then come back probably. But the message I would want to send to our audience is that the earlier you start to invest for your retirement, the better. And for the very young people, learn even to save your pocket allowance, even if it is by opening a money market account where you invest and learn how to operate it through M-Pesa, you withdraw. With the time, that is exactly where you put in any funds that you earn, maybe by way of an award. I know people who have invested award. They have written papers in campus, given an award, and they open a money market account with it. And I think it sets them good ground for starting. And there is nothing too little to save. Even 300 shillings is worth saving. When you are told to produce it and you don't have it, you see how difficult it is to have it. Therefore, the importance of putting it aside when you have it. Thank you.
Yeah.
I think picking up and my closing remarks would be, there's no income small enough not to allow you to save. I like saying that from the date when you were born, retirement was certain. And other than retirement, the only other thing that is certain is taxes and death. Retirement does not necessarily mean that you are not in any gainful economic activity, just as has been demonstrated. I think my panelists introduced themselves as retired, but along the way, I think you picked up they're actually doing some other things. So it is just a break in your routine, especially if you're in the employment world. It's just a break in your routine, and therefore now you're doing things a little bit more leisurely. You're doing things that you love to do, because in retirement, then you don't want to do things that you don't like. That would drive you crazy. What you want to do as well is ensure that it's not just the savings toward retirement that you're doing, but retirement planning is quite wholesome. Do the other things around your comfortable life in retirement. Get a home, go to school when, if you're that scholarly person, go to school while you're still active. It will help you like it is helping Dr. Ludo. Now he's imparting that knowledge back at the university. Get your professional qualifications like Yuna did. So she's using it to actually impact life in retirement. And I was having a conversation with her earlier. That is something she enjoys doing. So it's about just building yourself and your ecosystem around you so that you are very comfortable in retirement. But most of all, log into the AKI website get any one of the insurance companies that provide retirement benefit solutions. Talk to any one of them. I will promise you that the information you'll get from whichever company you pick will be top notch, and it will help you in your journey towards comfortable retirement.
All right, thank you all so much. I think from the sentiments and the comments and the questions, people have learned a lot. So as Paul has said, visit our website. I think the link is on the page on your screen, rather, www.akiinsure.com. You will find a page on retirement planning. It has answers to many of the questions that you've already asked. We've developed a very comprehensive list of frequently asked questions, and it has the contact details of all the 18 insurance companies that offer retirement plans. So get in touch with any of them today and start putting some money aside for that bright future. Your future self will thank you. Thank you very much and have a good night.
Thank you.
Yeah.
Thank you.
Why I like your reply.
Sorry?
I like your reply because I was discussing with your friends and they tell me now, we discuss with the